Okay, Bismillahirrahmanirrahim. Today in this session, we are going to discuss different questions. These are considered to be the most challenging or the most difficult questions, and definitely we'll be focusing on different standards as well. Because once we'll be focusing on the MCQs, that is the different MCQs from different standards. So definitely we will have a recap or the revision of the multiple standards in a very short period of time. So here is the question in front of your screen and on your screen. Let's read out the question and let's try to identify. First of all, this question has been taken from the March-June 2022 examiner report, and that question is related to IAS 16. Let's read out the question first and we'll try to identify the requirement and we'll see that how to solve this question. Okay, let's start with this one. On 1st January 20x5, Factman Company acquired a piece of equipment at a cost of 25 million. Always try to read the questions in bits of pieces. Never read the question in one go. Please try to read the question in bits of pieces and try to absorb the data that is given in the question. So this equipment cost is 25 million and it was bought on 1st of January 20x5. The equipment has a useful life of 5 years and the company must decommission the equipment. Now what is decommissioning? Decommissioning. The other name of the decommissioning is the dismantling.
Yes.
The other name of the decommissioning is the dismantling. So it means the company must decommission the equipment at the end of the 5 year period. It means that after a period of 5 years, the asset will be dismantled. Assets will be dismantled. Okay. Now, in a 5 years time, the estimated cost of the decommissioning in 5 years time is $10 million. And remember, this $10 million will be incurred after a period of 5 years. So this is the
Future.
yes, this is the future value. This is the future value. Fragment company's cost of capital is 10%. That is the rate of interest is already given. Now, the best part of this question is the present value of $1 receivable in 5 years' time at the discount rate of 10% is 0.621. What is this? This is basically the discount factor
After.
already given. Yes, it's already given in the question. So it means there is no need to apply the formula to calculate the present value. All what we can do that if the future value is given that is $10 million, if the $10 million that is 10,000 is the future value, what we are going to do
Times
just to
zero
multiply,
decimal
yes,
61.
0.621, 0.621. So we will arrive at the present value. Can you please calculate the present value for this one?
6210.
6210, that is the present value. Okay, so we have already calculated, although we haven't read the requirement that what examiner is asking for this in this particular question, but since we just read the question, so we just know about the treatment of this one, that if there is a dismantling cost, so dismantling cost should have been should be calculated at its present value. So we just calculated the present value of it. Okay, Factman company has correctly capitalized the equipment and recognized a provision for decommissioning at the correct amount. Okay, it means the company has already capitalized the equipment. It means the cost of the equipment is accurately and correctly calculated and recognize a provision for decommissioning cost at the correct amount. It means the provision for dismantling cost has already been recognized. Now what we have to do, that is the total charge. Total charge means that the total amount.
Which will be debited to profit and
Yes,
loss.
very good. Total amount which will be debited to the profit and loss account relating to the equipment and the decommissioning provision which will be required for the year ended 31st December 2005. It means we need to calculate the total charge to P&L. Total charge to P&L. Total charge means we will need to, there's a need to calculate the finance cost. Am I right?
Finance cost and depreciation.
Excellent. Can you please try this question and just let me know the answer of it? One more thing that you need to consider, that whenever in
Yes.
answers one whenever in the answers if the triple zeros are given, it means you will be working in thousands. If
Okay.
there would be have been a only a blank, if there had been a only the blank line, there is nothing written just after the blank, so you have to work out for the full value. You have to work out for the complete value like 10 million. So you must have write it down like 10 million. Are you getting a point? Right now,
Yes.
if triple zeros are given, so it means you'll be eliminating these three zeros. But if for example, if there had been like this, that after the blank there is a word million, so it means what you'll be doing, that you will be working like this one, 10 in times 0.621. Are you getting a point?
Yes.
So always read the requirement, that what requirement is actually given, whether the requirement is for the complete answer or for the values in thousands or for the values in millions. So please try this question.
Junaid, can I ask something?
Yes, sure.
In the question, it's written cost of capital is 10%.
Yes. It's
Cost of
basically the
capital
interest rate.
is the interest rate. It could have been different
No,
with the
no,
discount rate.
no.
It's the
Whenever,
same thing.
yes, it should always be the same percentage. By the percentage, we are calculating the present value. With the same percent, we will be unwinding the amount.
And if, let's say, there was another percentage just to confuse you, we will use the same rate
Yes,
for
you
finance
need,
cost
yes, you
or
need to ignore
discount
the
rate.
other one. Yes, you need to ignore the other one.
Okay.
Yes. Are you done with this one?
Yes.
So what's the answer?
12 to 10.
12 to 10. So how did you calculate this one?
So depreciation of equipment 25,000 divided by 5 years.
No, that is the blunder you made it out. That's why the examiner told you that these were the most challenging questions. It was not that a simple one. Majority of the examiner in the examiner report, examiner has identified that 90% of the students, what they did, they calculated the depreciation on the 25 million amount. But it's not the case. We have seen this in our exams or in our practice, that what we do, that while calculating the cost of an asset, what we do, that we need to capitalize the present value of dismantling cost, which means the cost of the property, plant and equipment. The property, plant and equipment was 25,000. Now what we have to do, we need to add the present value of dismantling cost, and we have calculated the present value of dismantling cost. This was the 6210. 6210, which means the total cost of the asset, would be 31,210.
Yes.
Yes, so it means that will be the cost of the property, plant, and equipment that will be depreciated. Let me repeat it again, that whenever there is a present value of dismantling cost, so present value of the dismantling cost should have been capitalized in the value of non-current asset. It should be the part of your non-current asset. So once you have calculated the present value of dismantling cost, this will be added in the non-current asset. Now the total value of the non-current asset is 31210. Now we will be depreciating the asset with this amount. So the depreciation, if you are calculating the depreciation expense for the year one, so it would be 31210 divided by 5. Can you please calculate?
6242.
6242. So that would be the depreciation expense for the year. And now we need to calculate the finance cost.
Finance
and
cost.
how, and how the finance cost will be calculated, that is the present value was 6210 in times
Oh, 10%.
10%. So what would be the amount for this one? 6210, 621, I guess.
Yes.
621. So what would be the total answer?
6242 plus 621. 6863.
6863. 6863 is going to be the correct answer. Are you getting a point?
Okay. Junaid, so the 10 million of this decommissioning or dismantling, it
Yes.
has, when we have calculate the present value, it's gone. We don't take it anymore. Even to calculate the finance cost, we take the present value.
Yes, very good. We need to consider the present value. That 10,000 would be irrelevant for me, as because this is the future value. Today we are going to recognize that amount at its present value. And once we have recognized the amount at its present value, what we have to do, we need to unwind it. We need to have unwinding. We need to have a finance cost entry that would be made at the end of the each accounting period.
Each year we put 6863. No.
No, this will not be the case. Let me give you an understanding for this one. First of all, this was the for the year one. Are you clear
Okay.
with this one?
Yes.
That is 31st of December 20x5.
Yes.
Now let's move on towards the year two. Year two, 31st of December 20x. Let's say if the examiner would have asked you regarding the requirement that what amount of P&L should be charged to 31st December 20x6. Let's take a requirement of this one. So now what you have done it, we know that the depreciation expense of all years
Depreciation will remain the same,
will remain the
25,000.
same. That is
Yeah.
31210 divided by 5, that is 6242. Are you getting a point?
Yes.
Depreciation, the amount of the depreciation will remain same
Same.
because we are using the straight line method.
Yes.
Now, whether the question is whether the finance cost will also remain same, no, this will not be the case. I think that you have not watched my video that I have given to you related to the dismantling cost. You have not yet watched that video. In that particular video, I have discussed this thing that if we are doing the unwinding, let's say unwinding for the year two, so what we'll be doing, that first of all we'll take the present value. This was 6210, is it?
Yes.
Now we will add up the interest for the year one, that is 621.
Okay.
Now, why? The reason, the concept behind is that the liability at 1st January was 6210, but throughout the year the liability was outstanding, and at the end the another interest was recognized with the amount of 621. So now the liability at the end of the year 2, now the liability at the end of the year 2 is 6210 plus 621. So the total amount of the liability would be,
6831.
and we are going to apply on that total
9%.
liability the 10%. So what will be the amount?
683.
683. Then the total charge to PNL would be,
6242 plus 683.
yes, 6242 plus 683,
693.
69,
6925.
69,
25.
6925. Are you getting a point?
Yes.
So this would be the case, and this will be the strategy to solve the question.
Okay. They won't ask you for more than 2 years, right?
Sorry?
They won't ask you for more than 2 years.
No, examiner won't be asking for more than 2 years. For example, if the examiner would have asked you for the year three, let's say, your hard luck, and examiner asks you that go for the year three. Now, can you
Okay.
please calculate the
The
values for this one?
depreciation will be 6242. The
Nice,
finance cost will be 6210 plus 621 plus 683.
excellent. Now you got the point. Now you got the point. Are you getting a point now?
Yes.
And then we will apply the rate of interest, that is 10%. Is it clear to
Okay.
you now?
Yes.
Okay, one more thing that examiner might have tested over here. We are not only there to attempt the question and just to rush off. We are here
Yes.
to understand that how an examiner can be tested or how the question can be tested in different ways. For example, if the examiner said that we bought that equipment on 1st of August 2005, on 1st of August 2005, and the requirement is same, that is 31st December 2005. Now, would there be a change in the solution
Yes.
or the
Yes.
answer? Now, what?
Depreciation needs to be prorated and finance cost
Yes,
also needs to be prorated.
excellent. Depreciation and the finance costs both need to be prorated. Are you getting a point?
Yes.
There will be no change in the present value. Present value would have been the same, but once we are calculating the finance cost, we need to prorate it for from August till December. That is August, September, October, November, and December. It means multiply by 5 and divide it by 12. Are we
Yes.
clear on this one?
This one, yes.
Okay. We have another question, and this question is related to IFRS 15.
Which question is this?
This is the OT
Yeah,
case
I got it.
basically.
Yes.
This is the OT case. Let me enlarge so that you can read it
It's
properly.
okay. I got it on paper.
Sorry.
I got it on the paper. I printed it.
Okay, okay. You just got the printout of it. Nice,
Yes.
intelligent.
Okay.
Okay. So here we go. That is the question. March, June 2022. That is IFRS 15.
I
IFRS 15.
revenue.
Okay. Yes, revenue. There are basically three contracts. There are basically three contracts. The first contract is on the 1st of October 20x6. We need to
Yeah.
identify the contract with the dates. Okay. Second
Okay.
contract is on 18th of November, and the third one is the 1st of December.
Okay.
These three contracts are independent. It means there is no link between in these three contracts. These three contracts are independent. Are we getting my point?
Yes.
Okay, let's read out the question. Remember, this is the OT case, and with that particular case, examiner would be asking five MCQs of the five questions. What
Mm-hmm.
my perception is, that is one of the most easiest part. Reason being, because once you will get the question, once you will read the question properly, so you need to absorb the information one time, and with this related information, you have to solve five MCQs, that you need to attempt five questions as compared to the section A. If there are five MCQs, definitely that there will be five questions, and every question will have
This
different
one chapter.
standards and different requirements and the different data. So
Yes.
I think this is a time saving, that if you will focus and you will read the question properly and digest the data, so it would be easy for you to answer the question. One more thing, whenever you will attempt OT case, remember, in OT case, if there are five MCQs, out of five, three would be an easiest one. Out of five, three MCQs would be an easiest one. Are you getting a point?
Yes.
You will not face any difficulty on those three MCQs. Yes, the two MCQs might create some trouble for you, but hopefully that three MCQs will be very easy and you can attempt it very easily. So let's read out the question and the requirement, and then you will try to solve the question. Berge company is in the process of preparing its financial statement. The year end is 31st December 20x6. There are three transactions which are not yet been accounted for. Number one, a sale was made for a large piece of technical equipment which included 3 years service plan. The total sales price is $1.8 million, which was paid on 1st October 2006. It means on the same day the amount was paid, and the technical equipment was delivered on that date, which means we sold an equipment along with the 3 year service plan, and the transaction price was 1.8 million, and the total amount was paid on 1st of October 20x6. Now, on its own, the technical equipment would normally be sold 1750, and a 3 year service plan would be normally sold for $1,65,000. Can you please identify that what these values represents?
The 175 is point in time.
Yes, it's point in time, but that 1750 and 1,65,000, can you please name these things, that what it represents?
165 is the overtime, right?
Yes, I agree with you, but these are known as what, the standalone prices. What do we call it?
Okay, standalone prices.
Yeah, it's known as what? Standalone prices. And that 1.8 million, that is 18 lakh, it is the total transaction price. Are you getting my
Yes,
point?
yes.
Okay. Now, second requirement, or the second case, or the second machinery. Machinery sold by Berge Company in January 2006 was found to be faulty, and various parts were replaced by the Berge Company under warranty. Berge Company would normally sell the replacement part for $80,000. The cost of Berge Company of these replacement parts were
Becomes.
$60,000. Now, the third requirement, or the third scenario is Berge Company entered into a contract for the sale of goods for $200,000. Berge Company received $200,000 on 1st of December. It means it sells goods for $200,000 and received the amount on the same date. Now, Berge Company has the right to repurchase the goods on 1st of April for $240,000. Now, these are the three different scenarios. These are three different contracts or the agreement. Now, what we have to do, we need to read the requirement, because you will not be able to understand that what to do unless you will read the unless you will read the requirements. So there are requirements. Let's see the first requirement. Which two of the following criteria are required before an entity should account for a contract in accordance with the IFRS 15, that is revenues from contracts with customers? You need to identify two criterias that are required before an entity should recognize the contract, which means you need to identify the two criterias that would be required in order to recognize the revenue. Can you please try this one?
A and C.
Nice, very good. That is, all parties to the contract have approved the contract. You must have remembered this one, that we discussed it. The Here the examiner is testing for the five-step model. Am I right?
Yes,
In a five-step model, we saw that the first thing is that you need to identify the contract. So all parties to the contract have approved the contract. And remember, the contract must be in writing. It's not necessary. The contract could be a verbal as well. The contract must have a commercial substance. Is it true?
yes, yes,
Yes. There should be a business contract. There should be a business agreement. And the last one is the it is possible that the consideration will be collected from the customer. No, if it is possible that the consideration will be collected, so it will not be there is no commercial substance. This should be probable. This should be probable that the consideration will be received. If the consideration will not be received, IFRS 15 states that there is no need to recognize the revenue. Are you getting my point?
yes.
Okay, now another question is, IFRS 15 revenues from contracts with the customer requires the transaction price to be allocated to the performance obligation in the contract. True?
Wait, wait, wait. Revenue from housing advertising have to be allocated. Yes,
Yes. Is it? Step number one, that is identify the contract. Step number
yes.
two, identify the
Define the
separate
price.
performance obligation.
Okay.
Step number three, determine the transaction price. And
Yes,
step number four, allocate the transaction price to each separate performance obligation. So the
yes,
statement given over here, that is revenues from customer requires that the transaction price to be allocated to the performance obligation in the contract. Yes, it's a true statement. Now, where each performance obligation is satisfied at point in time, how should the allocation of the transaction price be made? If
okay.
the allocation, if the performance obligation is satisfied at a point in time,
When it is point in time, we need to
if the performance
D,
obligation is satisfied in the point in time.
D.
Last one,
Yes.
can you please reconsider the option?
Point in time. It's when you are having all the delivery right now, but point in time you can have a discount. Wait, the transaction is from when the contract.
Always
Not
try to,
A, not A.
al- not a very good. Always try to eliminate the incorrect options or the options that are irrelevant. First of
Okay,
all, you eliminated the option A. That's perfectly fine. Can you
the
please read the
transaction.
option B and try to identify whether it's
Okay,
relevant or not?
the transaction should be allocated the standalone selling price. B.
Sorry?
It's the second option.
Yes, it's B. I told you, no? You just need to read the option very carefully. Don't rush off towards the solution. First, whenever you have a theory, that is something a theoretical MCQ. Are you getting my point?
Yes.
This was something a theoretical MCQ. So examiner highlighted in the examiner report that once I'm testing to the theoretical reports or the theoretical answers or theoretical questions, students, most of the candidates are not able to solve just because of it. What my perception is, because students are not reading the question and the requirements properly.
Okay.
Once you will read it and with a peace of mind, hopefully you will arrive at the answer correctly. Are you getting a point? Let's read
Yes.
the option. The transaction price should be allocated relative to the standalone selling price. True or false?
True.
Yes, what we did, that we need to allocate the transaction price to each performance obligation with respect to the standalone selling price. Do you remember the calculation
Yes.
of the components part at the date of, and when it should be done at the date of the contract of inception? Why at inception means at the time, at the initial stage, at the beginning. Initial means that is at the beginning. So it means you, what you need to do, you need to recognize the transaction price at the beginning, because the performance obligation is satisfied point in time.
Yes.
Okay, let's read out the D, which we have marked it first. The transaction price should be allocated. Nice, it's good. Based on the cost of the component parts at the date on which the contract is first agreed. No, we recognize the revenue when the performance obligation is satisfied. Are you getting my point?
Yes.
And not when the contract was agreed. So we recognize the performance obligation when the contract is satisfied or when the performance obligation is satisfied.
Okay.
And one more thing, there's a blunder in that particular scenario, in that particular option, that whenever we allocate the transaction price, it should be allocated on a stand-alone selling price. What I use the word stand-alone selling price. What I use the word, can you repeat?
Stand-alone selling price.
Yes, and here in the option D, it is written that allocate on the base of the cost. We never allocate on the base of the cost. Are you getting a point?
Yes.
We always allocate the selling price on the basis of stand-alone selling prices.
Yes.
Okay. Another question, that is this one. In relation to the sales made on 1st October, it means it's talking about the contract that was made on the 1st October, which means this contract. Are you getting my point? So now you have to read that area, you have to read that situation or read that part again to solve the question. So what it says, that on 1st October the sale was made, and what is the amount that will be reported in the contract liability for the service plan at 31st December 20x6. You need to find out, you need to identify the contract liability, that what amount of liability to be reported with respect to that scenario. Try this one.
Okay. I will try. Okay, so The question is done without the 30 again.
Yes,
Okay.
and it would be
I've
easier
already
for you.
calculated the yes. I've already calculated the discount. One
Good.
one
Is there any
five.
discount?
Yes.
Good.
1915. Yes, and the discount at series purchase there. Yes. Sets aside. Sales discount at series purchase there. And calculate this one exists. Oh, okay. Just a minute. Yeah. Discount. Social transaction. This also happens. Social transaction is part. Social transaction is part. This of the lower result. 13,000.
Sorry.
13,000.
13,000.
Yes.
13.
13,000.
13,000. So you are talking about the liability that should be reported.
Yes.
Okay, let's try to solve this one. Let's try to solve this one. First, what we have to do, if you can just recall, that first of all we need to identify the separate performance obligation. How many obligations do we have?
Two.
Number one is the equipment,
Equipment 1750.
1750, and the second one is the
3 year
service.
service
Yeah, it's a 3-year service plan, and the standalone selling
165.
price 165. So the total amount should have been
1915.
1915, and the total transaction price that we are charging is,
1800.
so it means there's a discount of,
115.
we need to allocate the discount to each performance obligation.
Yes.
And in order to calculate the discount, what we'll be doing, that 115 multiplied by 1750 divided by 1915.
1915.
Same goes with the 115 multiplied by 165 divided by 1915. So the amount of discount that will be calculated for equipment and the services,
I got 105.
sorry,
105.
105, and for this one,
10.
that is 10. So the discounted price would be 1750 minus 105.
Yes.
Answer would be
1645.
1645. And 165 minus 10, that is 155.
Yes.
So the total amount would be 1800.
Yes.
Okay. Now what we have done, that we have calculated the transaction price of each performance obligation. Now what we have to do, that we need to recognize that on 1st of October 20x6 we'll be recognizing the revenue. For example, if you talk about the equipment, so the revenue of equipment will be recognized in point in time,
Yes.
and the services would be recognized
Over.
over the time. Now, if we are recognizing the point in time, so 1645 will be recognized completely as a revenue. Am I right?
Yes.
So the amount which we have already received, and the entry that, although the entry is not required, but for the sake of practice, let's do it. That 1645, sorry, 1800 will be debited, and sales revenue of 1645 will be credited. Am I right?
Yes.
The remaining should have been recorded as an unearned, because the services have not yet been provided. till the 1st of October 20x6, although we have received the amount, but so far the services have not yet been provided. It means on 1st of October, the liability should have been 155. Are you getting a point?
Yes.
Now, let's move on towards the year end, 31st December 20x6. We have provided the services for October, November,
3 months.
and December. Am I right?
Yes.
And this amount of liability was for the period of 3 years.
36 months.
3 years means, yes, it's for 36 months. So we have satisfied the performance obligation for 3 months.
Yes.
So we will be debiting the unearned and crediting the income with the amount of 3 months. So 155 divided by 36 multiplied by 3. Am I right?
Yes.
So the amount should have been
13.
13. Is it?
Yes.
Now the remaining liability. What is the remaining liability at the end of the year? That is 31st December 20x6. What will be the
142.
liability that is outstanding? That is 155 minus 13. So this would be
142. But I gave you the answer 13. I won't get any mark.
okay. So you just gave me the answer for this one.
Yes.
Okay, this is not the requirement was that what will be the liability at the end of the reporting date that should be reported in the balance sheet.
Yes.
Are you getting a point? That what amount will be reported as a contract liability at 31st December?
Yes.
If the examiner requirement would have been that what amount of liability or what amount of service income to be recognized, what
13.
amount of service income to be recognized, so your answer was correct.
Yes.
Are you getting a point?
Yes.
And this is not only you that made the blunder. This is 80% of the students in that particular exams made this blunder.
Okay.
Did you got the question?
Yeah.
Okay. Now there is another question related to the scenario, and now
Yes.
here it is targeting for the 18th of November.
Yes.
18th of November.
Question
Here we go.
number 40 and various code type okay under warranty. Okay, but nobody said the replacement parts of the loss option.
D. Cost of sales will be reduced by 60,000.
Yes.
You are nearest to, but if you just read the situation again and you just reconsider your option, will the cost of sales be reduced?
There's already warranty, right?
There is already,
Warranty.
yes, the found that the faulty various parts of the replaced by the Berge company under warranty. Berge company would normally sell the replacement part for $80,000. That is the sales price. The total cost for these replacement was 60,000. It means the cost for the company or the cost of sales is $60,000. So now how the transaction should have been recognized? How the transaction should have been recognized? Whether the cost of sales will be reduced if you're providing the services and if you're selling the goods, so whether the cost of sales or the cost of goods sold will be reduced or it will be
No, it
increased.
will increase.
Yes, so it means this will not reduce the cost of sales. If we are recognizing the sales, so definitely the cost of goods sold will increase.
It will include 60,000.
Yes, it will include the cost of sales will include. So which options comes to you?
B.
Yes, the cost of sales will include. Yes, this means that cost of sales will increase by 60,000.
Okay.
Assuming no provision has been rest of the point or the rest of the statement is correct. Are you getting my point?
Yes.
So again, this was the question that was technical. Examiner states that what I'm discussing, whatever the whichever the questions I'm discussing, these were considered to be the most difficult questions. And what you have to do, you need to do all of these types of questions so that you can be aware of it. That if any of the similar question is tested in your exam, so you can answer it very properly.
Okay.
Okay. Now let's move on towards the last situation. First of all, I need to explain this one. Now always remember there is a concept of a repurchase agreement in IFRS 15. First of all, let me give you a concept for this one. Repurchase agreement. Now, what is repurchase agreement? For example, if you sold some goods or equipment, if A company sold some goods or equipment to B company, now you have sold that equipment for let's say $20,000. And once you sold that equipment, B company will pay you the amount of $20,000. Now you received cash $20,000. You received cash $20,000 and you sold those goods. Now the problem is A company requires those goods or equipment, which means that A company is in a need of that equipment and they need equipment for production purposes or for their services. What they did, they made another agreement with the B company to repurchase that equipment. That once they sold it at the first instance, and then now what they're doing, they are going to repurchase that equipment from B company. It means that B company will be selling that equipment again to the A company at a price of let's say $30,000, which means now A company will repurchase the equipment. A company will repurchase the equipment at a price of $30,000. This price is known as what? The repurchase price. This price is known as what? The repurchase price, which means at the first instance, A company has transferred the asset to the B company, it sold the equipment to the B company. Now
Okay.
B company requires that equipment. They want that machine for production purposes. Now, what they did, they purchased the equipment again. They purchased the equipment again. And they said that we will pay you amount at some later date, and the amount that they will pay will be $30,000. Now, what is the
Okay.
benefit for the A company? For A company, the first benefit is they received $20,000 because they were in a need, they were having some need of money, so they got $20,000. And the second advantage is now the equipment is also retained by the A company. Are you getting a point?
Yes.
So now there's a benefit, there's a dual benefit for the A company. First thing that they retain with the cash amount. Second thing is that they retain with the equipment. Are you getting this one?
Okay. Yes.
Now, IFRS 15 states that if the repurchase price is more than the or equals to the, if the repurchase price is more than or equals to the original selling price, I repeat, if the repurchase price is more than or equals to the original selling price, then this would be considered as a financing agreement. This would be considered as a
Fine.
financing agreement, or we can say that it's a loan transaction. IFRS 15 states that don't make me fool. There is no sale transaction. What you have done, you transferred the asset to the B company and then again you bought that equipment from the B company. What the nonsense is it? This is such a nonsense. What the hell you are doing? What the hell you are doing? You just transferred the asset and on the same day again you bought that equipment on credit, which means what you have done, that you have taken $20,000, you have $20,000, you have taken the $20,000 and you promise that you will pay $30,000 in future. Don't you think that it's a loan transaction? Today you got $20,000 and after a period of 2 years you will be paying $30,000. Don't you think that it is the loan transaction?
Yes.
And if it is the loan transaction, can you please just let me know the difference between these two values would be known as what?
Liability.
Difference between the 20 and the 30,000. That today you got $20,000, and after the period of 2 years or 3 years, you will be paying $30,000. So difference between these two values is known as what? That is the difference between the 20,000.
Liability.
No, difference between the,
Interest expense.
yes, this will be treated as what? The interest expense. Are you getting a
When
point?
you're saying the financing agreement, you mean that the 20,000 which has been given, which has been sold to Bico, which was a loan, and
Excellent.
then when you
It's a
got it
borrowing.
at 30,000 more, it's
It's a repayment amount. It's a repayment amount that you will be
oh,
paying.
the 10,000 is the interest. Okay,
Exactly. And for example, if that difference is 10,000 and it's for a period of 2 years, it's for a period of,
2 years.
so it means this expense will be recognized over the period of 2 years, that is 5,000 each. Am I right?
Yes,
Are you getting my point?
yes.
So when it will be considered as a loan transaction, if the repurchase price is more than or equals to the selling price, original selling price.
Okay, and
Are
if
you,
repurchase price is lower?
and if the repurchase price is lower, this would be considered as a sale and lease back. Then
Okay,
it's a lease transaction. If the repurchase price is lower than the, if the repurchase price is lower than the,
selling price.
yes, original selling price, if the repurchase price is lower than the original selling price, then this will be considered as a lease transaction.
And it will be a liability, lease.
Yes, yes, yes,
Okay,
yes, exactly. Are you getting a point?
yes.
Now you just try to solve this one.
Okay, so what the revenues of my final account for 1st December exists in the statement of 31st December and died in half of the sawmill on 1st December. Forgy has a right to repurchase. Okay, repurchase price is higher. It will be a financing agreement
Very good.
of 40,000 for previous wait axis and more for 5 months. 40,000 for 5 months.
How can you
Mm.
calculate the 5 months? How is it 5 months?
For the month of December,
Yes,
January,
yes,
February,
yes.
December, January, February, March, April,
Uh-huh.
5 months. Oh, it and on 1st April, 4 months.
Yes, yes. Please read the question properly.
Okay, 4 months. So 40,000 for 4 months, which will be 10,000 for that month when the closing of year.
Okay, great.
Interest expense.
Now what you have to do, you need to drag and drop. You need to drag and drop that what
Yes.
amount of revenue to be recognized, what amount of interest expense, what amount of cash, and what amount of liability.
Okay. So revenue will be, I want the revenue, right? The original price 200,000 will be revenue.
Whether the revenue will be recognized.
No interest expense 10,000.
Yes. So will there be any revenue to be recognized? Is there any revenue to be recognized?
No,
No. So what will be the amount of revenue?
zero.
Nice. Very good.
Zero revenue, 10,000 interest expense.
Good.
Cash will be, we got cash 200,000
Very good.
and liability will be no liability.
No liability at the end of the reporting period. There is no obligation if there is a loan transaction, if there is a financing arrangement,
Oh, the 30,000, the remaining 33 months, right?
whether you have to pay only 30,000. You bought 200,000 right now. You bought 200,000 right now, and you promised that on 1st of April I'll be repurchasing I'll be repurchasing the asset for a period or for a value of 2,40,000. Are you getting my point?
Yes.
It means you have promised.
210.
Sorry.
210.
Yes, 210.
They are very easy, but they are very catching point.
Yes, you need to. These are always remember. Examiner says that we are not here to. We are not there to fail the students, or we're not here to take the revenge from the students. What they do, they just give you the data. All what you have to do, you have to be very concentrated. You have to be very alert. These are not that difficult. When you say that no, it's very difficult, I don't know the solution, I don't know the concept, you know each and everything, but you need to read the question and the answers and the options very carefully. Are you getting a point?
Okay.
But
Yes.
one more thing, these questions are not the normal ones. These are the questions for which the examiner states that these are one of the difficult questions and the challenging questions. Are
Yeah,
you getting
you're
a
right.
point?
Yes.
These are the ones which have a very high benchmark. So definitely, if these are the most challenging or the toughest question, so what in the exams will be tested? Definitely, this is going to be the lower standard or the lower benchmark.
Okay.
Okay, now.
Which one? Okay. Oh, that's nice. Good information. Mm, it's okay. Hello.
Hello, yes. Are you done with this one?
Yes.
So what's the answer?
The amount of deferred tax liability is correct.
Okay, and what about the amount of revaluation surplus?
I'm not sure.
What's your intake?
Correct.
Correct?
Yes.
Yes, both the statements are correct.
So just let me know. For the
Okay,
land, it's account base is 280, and for tax base it's 200. So
very
you
good.
get a difference of 80,000.
Nice.
added to the 10,000 upstairs of 100 for the plant.
Mm,
90 and 110.
okay, the difference between these two is
Yes, 20,000.
20,000. Okay, so it means total.
100 times 20%, then you get 20,000 for the deferred tax.
Very good. 20,000 is
That's
the
okay.
deferred tax liability. Very good.
And as for the
It
revaluation
means it
surplus,
means it means it means that amount is correct. Am I right?
yes, yeah.
Okay, now move on.
As for the revaluation surplus, it's 80,000. We need to
Reva
do the
Yes, exactly. Revaluation surplus. Although the revaluation surplus was 100,000, is
no,
it?
it's not
No, no.
100, it's
Sorry,
80.
sorry. 80,000.
Yes,
Revaluation surplus is 80,000.
yes.
And again, what would happen?
20 times 20%,
Yes, 20,000 times 20%. This will make.
16%. The difference only which needs to be credited to the revaluation surplus.
Yes. Are you getting my point?
Okay.
So the revaluation surplus balance is also correct. Are you getting my point?
Yes, good.
Okay. By the way, congratulations. You solved the difficult one.
Thank you.
Huh? That's good.
And the second one,
Yes, this one is from IFRS 9.
what's that? Okay. Financial instrument. Oh, I can verify it. Oh, okay.
First of all, identify whether it's a financial asset or the financial liability.
Uh, Purchase investment loan note will be liability.
No. What we are doing, we are purchasing. If we are
Yes.
purchasing, it means we are making an investment.
Yes.
So it couldn't be the liability. It's an investment. It's a financial asset.
Oh, okay.
Once we are making an investment, it means it's a financial asset.
What's that?
Okay. On 1st of July 2007, a company purchased a 5-year loan note investment. It means it's an investment with a par value of $7 billion. It's a par value.
7 million.
Okay. Now investment was purchased at a 12% discount, which means the
Market
par
price.
value was 7 billion, that is 7,000, but
Yes.
investment was made at 12% discount.
Yes.
So it means 88%. Can you please calculate the 7,000
840.
into 6160? 88%. If I just calculate the 88%, are you getting a point what I'm saying?
I would have done 7,000 times 12% and then 7,000 less 80.
Okay, so what would the answer?
Wait, 6160.
Yes, 6160. Is it?
Yes.
So it means company purchased loan notes, that is the debt instrument purchase for $6160. The loan had a coupon rate of 5%. That is the coupon rate, and
Yes.
effective rate is 7%. Is
Yes.
it? Okay. The company has the intention of holding the loan note to receive the contractual cash flows. Now we know that if there's a question of the financial asset, if there's a question of financial asset, so financial asset we can invest in shares or we can invest in debts. Is it?
Yes.
If we can invest in shares, we have two different options. That is a fair value through P&L, or
Of
we can
fair
use
value
OCI.
OCI
But if you're going for the debt, we have three
and
options:
amortize.
amortized cost, fair value through OCI, and fair value through P&L. But for
Uh,
exam point of view, amortized cost is being tested. Am I right?
yes.
So
In fact, at start when I told you it's a liability, I meant it's a debt.
okay, 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 I got it. Sorry, sorry for
No, it's okay. It's
misconception.
okay.
I
No, it's
got it.
okay.
Yes, yes, it's an investment in the debt instrument. Yes, you're right, absolutely right. So financial asset, it means you're making an investment in the debt
That,
instrument in a liability instrument. Absolutely right. So it means we need to account for using the amortized cost. Are you
yes,
getting a point? Now, what we have to do, we need to calculate the finance income at the end of the year, 30th June 2009. You need to consider that the examiner is asking for the information that is after 2 years. Am I right?
yes,
After 2 years means 2008 and 2009. So what we have to, we need to prepare the table.
yes,
Can you please try this one and calculate the interest income for the year two?
yes. Effective rate, coupon rate. What is that? So, first balance, basis, opening balance, investment, investment.
Once you will start the table with what value? Which value will use when
The
you start?
investment 6160.
Excellent.
Wait, six two four one 624. That's it. So then we can find it. Just employment. What's the question? How much finance income should be effective? Should be required for the year ended? It's 437. Hello?
Can you please repeat the answer?
437.
437.
Yes.
Absolutely fine. Great. Is it clear to you now?
Yes. This one I have understood. For example, this when we need to do the amortize or when there's a convertible also.
Are you clear with this one now?
Yeah.
Great. Nice. Good. Okay. Now there is an OT case,
Yes.
and that is related to IAS 20 and IAS 40.
Um, which, can I know which year?
It's, I guess, let me tell you, September, December 21.
Oh, that's what we are doing, right?
Yes.
Okay, I got it. Here, challenging question. Okay. The following issues relating her non-current and outstanding. Okay. We get three questions of OTC, right?
Sorry.
How many questions of OTC we get?
There will be three
Wait.
OT cases in your paper,
Okay, good.
and each OT case will have 5 questions.
30 marks in all.
Uh, 15. Sorry,
13 marks in all.
30. Yes, 30 marks in all. 30. 30 marks in all.
Yeah. We don't have Anha, Kanama, Ikada, Question 5. It is a head office only.
Sorry.
Question 5. It is a.
Okay, are you done with the question number one?
That's what I did.
Okay, this one.
Yes.
Okay, okay. So, uh, let's read out the question first. First of all, there's a factory, head office, and machinery. Factory at 1st January 2007. Company's factory had a carrying amount of $5 million. It has a remaining useful life of 10 years at that date. At 31st December 2007, that is at the end of the year, there was an impairment review of the factory and the recoverable amount deemed to be 2.5 million. Okay, so carrying amount at the start of the year was 5 million and the recoverable amount at the end of the year is 2.5 million. Company's factory had previously been revalued upward and the revaluation surplus had a credit balance of 1 billion relating to this factory. Nice, good. Okay, head office. Company's head office cost 12 million on 1st January 2001, is being depreciated over a period of 40 years. On 31st December 2004, there was an impairment review. There was an impairment review of the head office and the recoverable amount was deemed to be 9 million. Okay, it means 12 million was the carrying amount at the start of the year, and at the end of the year, that is 2002, 3, and 4. After 3 years, the recoverable amount is 9 million. A more recent valuation at 31st December 2007 has estimated a recoverable amount of 11 million. Okay, machinery. On 1st April, company received a grant of 2.6 million towards new production machinery. That is something that is related to IS-20, I guess. Is it?
Yes.
Okay.
Grant.
Yes, grant. So the details are given, and the company uses the cost model when accounting for its head office and deferred income method. It means for head office, it is used as a cost model. Am I right?
Yes.
And for this one it's using the revaluation surplus model, is it?
Which one?
Because
The first one, yes.
yes, because revaluation surplus is given, that shows that here the company is using the revaluation model. Now what's the requirement? Which of the following assets belonging to the companies require an impairment review?
The head
annual
of.
im- annual impairment review. I just told you when we were doing the IAS 36, that is the impairment of asset, that impairment testing is always done when there are certain indicators.
Okay.
I told you
So
this one.
it. Yes.
Impairment impairment review should only be done if there are certain indicators, and indicators could either be the internal indicators or this could be an
External indicators.
external indicators. There were different and I told you to remember and to recall or to memorize those points.
Yes.
These are very important indicators. Let's say for example decrease in the market value, increase in the interest rate, and if there is any accident. So these are the indicators, that is the internal as well as the external indicators. There are only two assets that should be reviewed for the impairment annually.
Goodwill.
Can you remember those two assets?
Goodwill.
Nice. And any other intangible
Asset.
which has indefinite useful life,
Okay.
Are you getting a point?
Yes.
So which means that if there is any asset that is the goodwill or intangible indefinite useful life, so this will be tested for impairment annually. Otherwise otherwise if there is any other asset, will only be tested for impairment if there are certain indicators. Are you getting a
Oh,
point?
yes.
Here what is written, that which of the assets will be tested for annual impairment review? Now can you
No
please
one.
answer? No one, neither,
Did.
neither. Yes, are you getting a point?
Yes.
Okay, go for the second one. IS 36 impairment of asset. What is the correct general entry for the to reflect the depreciation and the impairment for the factory? Which means this one.
Factory. The
You need
first
to
one.
Yes, you need to recognize the impairment as well as the depreciation.
Yes.
Can you please calculate and record the entry for the impairment and the depreciation? And then we will
Yeah.
match the entry for this one. Remember, the carrying amount is given on 1st of January and impairment was tested on the 31st December. It means you need to calculate the depreciation for the year one.
Yes.
Good. First, calculate the depreciation and mark it and put it on the, just keep it on the reserve side. Then go for the impairment review.
I got the impairment of
Good.
2 million.
Sorry.
Impairment is equal to 2 million.
Okay, let me calculate it with you. First of all,
Okay.
we had a carrying amount of 5 million and we are going to depreciate it over the period of 10 years. So we just
Yes.
got the depreciation of 0.5, is it?
Okay.
And then at the end of the reporting date, now the carrying amount would
4
be,
decimal 5.
yes, carrying amount would be 4
Million.
decimal 5 and the recoverable amount is,
2 decimal 5.
now the carrying amount is greater than the recoverable amount. It means asset is said to be impaired, is it?
Yes.
So now we are going to record the impairment loss for, but we have already the revaluation surplus of 1 million. So what we'll be
Yes.
doing, we'll be reversing the
We will
revaluation
debit revaluation surplus
PNL debited by
the remaining 1 million.
1 million and the property, plant and equipment would be credited
2
by,
million.
so that is the entry for the impairment and the entry for the depreciation, and the entry for the depreciation was depreciation expense debit
And
and accumulated
credit
depreciation
accumulated depreciation.
or property, plant and equipment will be credited with the amount of zero point 0.5 million. Is it?
Yes.
Now, can you please mark the answer that which, here the entry is compounded. There's a compound entry for this one. You need to compound, you need to merge both the entries. Can you please identify which one will be the correct one? If we just
Yes.
look at the PNL, will be debited with the amount of 1.5
P&L will be 1.5. Revaluation surplus 1 million.
and PPE will be credited by, is it?
Number equal 2.5.
Yes.
A.
Are you getting my point?
Oh, yes.
So you mark the A,
Yes.
you did the same thing.
Yes.
Nice, very good. Okay, now let's move on towards the head office accounting. What is the carrying amount of the head office at 31st December 2007? Head office means here. Here it is.
Number 2.
Yes, 31st December 2007. That is after it was bought on
1st
1st
January
January
it's fine.
2001. Then 2002, 3, and 4, there was an impairment review. And then again, after 5, 6, and 7, after further 3 years, there was again an impairment review. So you need to calculate the value at 31st December 2007.
Carrying amount. So, recoverable amounts.
Yes, are you done with this one?
Yeah, wait. Record. Yes.
So what would be the answer for this one?
D.
D. You need to say that 11 million.
Yes.
Okay, let's work it out again.
Is that
Uh,
good?
Let me try. I don't know.
Okay. Okay.
Let's work out for this one. First of all, company's head office cost is 12 million on 1st January 2001, and it's being depreciated over a period of 40 years life. Okay, on 31st December 2004, which means 1, 2, 3, and 4. We need to calculate the depreciation for 4 years.
Yes.
So it was 12,000 divided by 40
D.
multiplied by 4. So the depreciation amount of the depreciation for the 4 years would be
1.2 million.
1.2 million. That is 1200.
Yes.
So 1200 is the depreciation. And what happened at 31st December 2004? There was an impairment review. So let's calculate the carrying amount. That is 12,000 minus 1200. So what is the carrying amount?
10,800.
10,800. And the recoverable amount was
9 million.
9 million. If the carrying amount is greater than the recoverable amount, an asset to said to be
There's an
impaired.
impairment.
So there's an impairment of
1,800.
1,800. That is the impairment loss. Now let's move on. After this one, a more recent valuation, the 31st December 2007 estimated recoverable amount is 11 million, which means after how many years? That is
3 years.
2005, 6, 7, 3 years, which means we need to calculate the depreciation for 3 years. So now
Yes.
the depreciation will be calculated 9,000 divided by
36
36
years. Yes.
and multiply by 3.
3 years.
So what will be
750.
750 is the depreciation. So the carrying amount will be 9,000 minus 750. Is it
8 to 50.
8250? Now the recoverable amount
11
is
million.
11 million. Recoverable amount is 11 million. That is 11,000. Is it?
Yes.
Now there's a need to consider this one. Need to consider this one. Here, is there any impairment?
No.
No, there is no impairment, although there is a reversal of impairment. Am I right?
Yes.
And once there is a reversal of impairment, always you need to consider that whether the company is using the revaluation model or the cost model.
Cost.
If the company is using the revaluation model, so it is quite simple that revaluation surplus will be debited and the remaining amount will be charged to P&L. But if we are using the cost model, IAS 36 states that if you're using the cost model and if there is a reversal means you will increase the amount of asset. Am I right?
Yes.
Increase the amount of asset, increase the amount of asset to the higher of,
Higher up.
to the higher of, sorry, increase the amount of asset to the lower of, two things. Number one, that is the recoverable amount or the carrying amount if there had been no impairment. Let me give you the understanding of this one. I repeat, if you are using the cost model, then if there is a reversal of impairment, what you have to do, that increase the carrying amount. First of all, reversal means you need to increase the amount of an asset. So you need to increase the amount of asset to the lower of, increase the amount of asset you need to increase, but to what value, to what extent I should increase. So to need to increase the amount to the lower of, number one is the recoverable amount and the second one is the carrying amount. Now, what is the recoverable amount? That is 11,000. Am I right?
Yes.
And what is the carrying amount? Which carrying amount you're talking about? I'm talking about the carrying amount if there had been no impairment. Assuming that if there had been no
Oh,
impairment, assuming, so it means from 2001 till 2007. How many years? 2001, 2, 3, 4, 5, 6, and 7. That is 7 years.
yes.
That for the 7 years, if there had been no impairment, what carrying amount would have been there? So it means the cost of the asset was the cost of the asset initially.
12 million.
Yes, at the time of birth, it was 12,000.
40
So which
years.
means 12,000 divided by 40 multiplied by 7. So the depreciation of the 7 years would have been
2 million. 2100.
2100, which means the carrying amount, if
Would
there
have
had
been
been, would have been 12,000,
99.
9,000.
12,000. 12,000 minus 2100 is equal to 9900.
9900,
00.
9900, which means that if there had been no impairment in the past, so the carrying amount would have been 9,900. Now IAS 30 states that you can only increase the amount of your asset only to the lower of whichever is lower. Just let me know whether the recoverable amount is lower or the carrying amount is lower.
The carrying amount.
It means you can now increase the value up to the value of 9,900. You cannot increase the value up to 11,000. Reason being, what is the rationality behind it? Because that 11,000 is basically the market value. Am I right?
Yes.
And don't forget you're using which model?
Cost.
So in being if you're valuing your asset as per the cost model, how can you recognize the asset at its market value? So the maximum reversal that will be allowed,
Carrying
the
amount.
maximum, yes, the maximum reversal in that situation that will be allowed is 8250 minus 9900. So what will be the maximum reversal?
9900.
Reversal,
Oh, maximum under revaluation.
reversal, maximum reversal. That how much amount we can reverse? That is the difference of 8250 minus 9900.
When did you get 8250?
It's a carrying amount.
But we were trying to see
Once we are
the,
having a we were having an impairment review at 31st December 20x7. What we did, we
yes,
first calculated the carrying amount.
yes,
So 9000 divided by 36 remaining life multiplied by 3. So we had a depreciation of 750.
yes,
So we
I
had a
got
carrying
that.
amount that 8250. Now we were having a recoverable amount of 11,000 that was given in the question. But the problem
Yes,
is, we are using the cost model. We are using which model?
cost mother.
We cannot reverse it by 11,000. We cannot value our asset at 11,000. We need to have a check and balance first.
Okay,
As per the cost model, if you're using the cost model and if there's a reversal of impairment, so we can increase the amount of asset, we can increase the amount of asset to the lower of, to the,
lower.
we need to calculate both, we need to identify both the recoverable amount and the carrying amount if there had been no reversal, if there had been no impairment basically.
Yes, this
So
one
we,
is okay.
yes, so it means we will select the lower of, 11,000 is lower or the 9,900 is lower.
9.9 is lower.
It means now we will consider the recoverable amount 9.9 instead of 11,000.
Or 9.9 becomes the recoverable amount.
Excellent. This will be treated as now recoverable amount. Why not 11,000? Because you're using the cost model. You cannot exceed your value of asset to the market value.
Okay,
If there had been a revaluation model, so there would have been no problem. You can increase the value, you can recognize your asset at its market value. But in cost model, you never recognize your asset at the market value.
okay.
So if I just ask you that what will be the amount of reversal?
So 9900 minus 8250, 1650.
Yes, 1650 is the amount of reversal. But right now here the requirement is bit different. Here the requirement is that what will be the amount at what value the head office should be reported in the statement of financial position. So what will be the amount at which the financial statement, in which the
B,
financial statement the asset will be reported?
B.
Yes. Are you getting this one?
Yes, 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 yes.
Is there any confusion?
Oh, it's okay. It's 900. But for 2 marks, it's a lot.
Yes. I would definitely agree with this one. But I told you that in OT case there will be three MCQs that would be quite straightforward. There will be
Yes.
one or two that will tease you, that will trouble you, that will bother you. If you just read the second last one, hopefully you will give the answer promptly.
Which of the following is coming the deferred was deposit? D, the last one.
Grants related to the asset can be accounted for using the either the deferred income method or deducting the, very good. Why not A, by the way? Let me read out. The deferred income method should always be used for the grant. No, it's not necessary, right?
Yes.
Grant related to the income must be disclosed separately in the statement of profit or loss. No. The deferred income method should only be used for the grant is repayable. No. Very good. Excellent. Option D is the correct. Did you got my point? So in
Yes.
every OT case, there will be a simple question. Now, whatever the time you have spent it in the previous MCQ, this will be saved in that particular one.
Yes.
Now, can you please do that one last one?
Yes.
Remember, in this question, he's asking, or the examiner is asking for the non-current liability.
Yes. This one is set of
Yes.
wait. Sex over. Sex over. Upon this is soft as sex over. That over. Oh,
Sorry.
A.
A. Okay, let's do this one. What is the amount of grant that we have received?
We have received 2.6 million.
2.6 million, is it? And the life of the asset is
5 years.
5 years. So the annual release would be
Annual release, you mean? Okay. So we take 2,600 divided by 5, we get 520,000.
that is 5.2.
Yes.
No, 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 0.52, I guess.
Okay.
Can you please have a working in decimals? Because the requirement is in decimals, so we will be working for decimals as well.
Okay.
So we have 2.6 million, and the life is 5 years. Okay, 5 years. So the annual release would be 2.6 divided by 5.
Yes.
The answer would be 0.0
2.6 divided by 5, 0.52.
decimal 52. Is it? That is the annual release that will be made out. Okay. Now what we have done, the grant was received on 1st of
April.
April, which means April,
Oh,
May, June, July, August, September, October, November, and December, which means 9 months. We will release the grant for the 9 months. Is it?
okay.
So the deferred income was 2.6 million and 9 months. Can you please calculate the deferred income that will be released or will be transferred to the other income for the 9 months?
0.39.
0.39 is the amount that will be released. So the remaining liability at the end of the reporting date would be
So 0, no,
2.6
2.6 minus
minus,
0.221 C.
sorry,
Come. C.
See, 2.21,
2.21, yes.
but that is the total liability. That is the
Total liability.
Yes, that is the total liability. But if you just look at the answer or the question or the requirement, here the examiner is asking for the non-current liability. And what is the non-current liability? Non-current liability is the liability that will be settled after the period of 12 months, which means that 2.21 is the total liability in which the certain amount will be released in the next 12 months, and the amount that will be released in the next 12 months would be 0.52. Am I right?
Yes.
That is, in the next 12 months you will release the annual release, that the annual amount, that is 0.52. So which means out of 2.21, 0.52 will be released in the next 12 months, and the remaining, what will be the remaining amount? That is 2.21 minus 0.52. So the remaining amount would be
169.
1.69.
Yes.
So 1.69 is the long term liability. Are you getting a point?
All the answers are in the question.
Sorry.
All the answers that we have worked are in the question. 2.08, 169, 221,
Yes.
except
Ye-
156.
yes, yes, exactly. The examiner was trying to. That's why examiner told you that these were the most challenging questions, because the answers and the questions and the options, there was something, there was a lot of confusions, or there a lot of examiner has tried to play it with the students or the candidates.
Okay.
Are you getting a point?
Yes.
So you have to be very alert for this one, that whether the examiner is asking for the total liability. If the examiner would have asked for the total liability, so this would have been the total. This would have been the correct answer. But if the examiner was asking for the current liability, so this should have been the correct answer. But if in that particular question here the examiner was asking for the long-term liability, so this is the correct answer.
Okay.
And if the examiner would have asked you that what amount of income to be released in the year one,
0.39.
nice, very good. Are you getting my point?
Yes.
Is it clear to you now?
Yes.
So these were the few questions that was from the past examiner reports, and hopefully in the next session we have more questions, and we'll try to what is the advantage of these questions, that automatically the topics and the standards are being revised, and
Yes.
you will get to know the difficulty level, and you will get to know the idea of the examiner, that how and what can be tested in the exams. So basically, the purpose of solving these questions and to attempt these questions is to have a grip and understanding on a majority of the standards. Like we discussed in that IFRS 15, in these particular questions, we also recapped IAS 36. We gone through the IAS 20. We gone through the IAS 16, IAS 12. So by discussing these 8 to 10 questions, what we did, we recalled multiple standards in a very less period of time. Are you getting a point?
Yes.
So this is the advantage of discussing these different types of questions, or the different questions or different variety of questions. So hopefully in the next class, inshallah, we'll be discussing more questions related to the examiner's report. Are we
Okay.
clear on this one?
Yes. When is the next class?
Okay.